Welcome to Market Matters, our markets podcast on making sense, the hub for JP Morgan Corporate and Investment Bank podcasts. In each episode of Market Matters, we discuss the latest news and trends shaping markets today.
The abnormal returns of trend-following strategies come from those few times where there are strong trends in the market and the stronger winners more than make up for the losers, which tend to be relatively smaller as well. I think the point is there is alpha to be made from those infrequent but strong market trends that happen from time to time. Trend-following strategies have arguably a natural stop loss embedded. That is, if there is a continuing trend on one direction, let's say long, a trend-following strategy is expected to be long that market. And when the strategy incurs a loss in that position, it also means there was a reversal in that trend or there's a discontinuity in the otherwise positive trend.
Hi, I'm Eloise Goulder, head of the Data Assets and Alpha Group here at JP Morgan. And today I'm so pleased to be sitting down with Jagadish Chalasani, who is our lead structurer for CTAs and who has been developing CTA and trend strategies here at JP Morgan over the last 12 years. So Jagadish, thank you so much for sitting down with us today.
Thank you indeed, Eloise. Very happy to be here.
So Jagadish, can we start by setting the scene and really focusing on where you sit within the business here at JP Morgan?
We sit within the broader market sales and trading division and cover the space of QIS or quantitative investment strategies. Now, these are systematic strategies meant for investors, and they commonly cover three elements within them. One is daily liquidity, second one being transparency, and the third one being efficiency from a cost perspective.
And our discussion today is focusing on CTA or trend-following strategies. So do these represent one sleeve of the investment strategies that your group look into?
Correct. Across the cross-asset spectrum, one could think of beta or market access being one of the sleeves, or linear alpha strategies being the second sleeve, or access to volatility instruments being a third sleeve, or more long-only multi-asset traditional investment sitting within a fourth sleeve within the business.
That's really helpful context. And the points you made about the three facets your broader business really tries to achieve: daily liquidity, transparency, and low cost or cost advantages. That's really helpful as well. So if we turn to CTA strategies, I mean, it sounds like a very ambitious undertaking to be creating and developing strategies that have a track record of delivering alpha over time. I mean, how much of a challenge has this been?
I think going back to 2016 or 2017, when we first set out to develop our CTA product, there were two types of challenges that we largely encountered. The very first one was more of a endogenous or inward challenge of being able to deliver the bank's trading muscle in such a product. Now, historically, banks were organized as various asset class trading functions, very specialized traders trading a very narrow scope of a certain market. And while that helps in order to gain expertise within an area, our challenge was to stitch up multiple functions together to be able to trade a wide range of markets across various asset classes. So we were very much looking into solving the challenge through connectivity of various systems and automation, such that we have a nimble daily trading cross-asset algorithm. The second one is more to develop IP or the right level of sophistication in running such a model as well. And for that, we had a lot of experience to lean on, mainly coming from our research function, where we had previous CTA practitioners writing research on the space, or within our team itself, with more than a decade of cross-asset systematic strategy experience within the team.
That's really interesting. So can we touch on the performance then of CTAs? I think it's widely known that over the longer run, since CTAs came into existence starting in the 70s and the 1980s and then continuing to emerge since then, performance has been strong. And in fact, if you look at academic research, I know that there's evidence of trend and there's evidence of alpha in trend way before the 1970s, going back perhaps 50 to 100 years. But then on the other hand, there was this period of weaker performance prior to COVID. And actually, we discussed this at length on prior podcasts on this series, both with Anthony Todd, who is CEO and co-founder of Aspect Capital, and also with David Dennison, who is Deputy CIO of Florin Court Capital. So Jagadish, from your lens, first of all, how strong has the signal been historically over the long run? And second of all, what did you observe prior to COVID?
You could think of the recent history as what happened during GFC, what happened after GFC, but before COVID, and everything else after COVID. Now, of course, CTAs came into the popular prominence post GFC, where they had a fantastic run on the back of super strong trends in the macroeconomic space as a result of GFC itself. The period after that, all the way to the run up to COVID, was somewhat disappointing for the average CTA investor. And there are many commentaries out there on why that's the case. And the more popular one is the fact that there was limited macroeconomic volatility in the market itself, coming from the abnormal central bank action of zero interest rates across most of the developed markets that we have seen. Now, COVID has changed that in many ways. If we go back to the days of COVID, the initial few months was a question of supply chain disruptions and heightened demand-supply frictions. That in itself was leading to stronger trends, as we have seen in physical commodities to begin with, falling on to rates and falling on to currencies as well. And the activity from central banks, if anything, has heightened ever since as well, with the rate cycle coming to a peak and a potential of reversal of that cycle coming in the next few months to years as well. So if you think of what we expect in terms of performance right now, there are a few things going in favor of CTA performance. And most of that boils down to the heightened macroeconomic volatility, call it higher for longer rates environment or higher inflationary regimes, increased trade and information barriers across various countries that we are seeing more recently as well. All of these do favor trend following strategies.
That's fascinating to hear about the relatively stronger performance in CTAs post-COVID for all of those reasons that you mention. I mean, what are we talking here in terms of the scale of outperformance and perhaps the periods in which performance has been particularly strong post-COVID?
So the period of COVID itself, 2020 and 2021, CTAs have done positive single-digit territory. So 2022 period was phenomenal from a performance perspective, where CTAs have recorded anything greater than 20% performance on a volatility of 10%. So 2022 was where inflationary trends peaked. And there was strong performance coming from short exposure to fixed income, long exposure to commodities, and FX as an asset class delivered decent returns as well. And it was a good reminder that the premise of diversified exposure across various asset classes, as we've seen with fixed income, short exposure to fixed income hasn't produced a sustainable positive performance in most CTA models for more than 2 decades. And that was one of the strongest contributor when it comes to the inflationary period of 2022.
Yes, it's been reassuring to see some of these trends coming back and certainly this performance coming back, because I know that there were question marks as to whether this source of alpha was commoditized or had waned for some other reason. Perhaps the markets were becoming more efficient at pricing things in quickly, for example. So very reassuring to see that actually all of that academic literature going back all of those decades has held true in the post-COVID period. So that's on outperformance of trend following strategies. What about the vulnerabilities? I mean, the obvious vulnerability to this sort of a strategy is when the regime changes. How do your models go about managing that?
I think before diving into the way we tackle the problem of trend reversals, if we take a step back and look at the premise of the trend risk premium itself, right? Now, from a hit ratio perspective, trend following is not a great signal that one could find. But the abnormal returns of trend following strategies come from those few times where there are strong trends in the market and the stronger winners more than make up for the losers, which tend to be relatively smaller as well. So I think the point over there is there is alpha or there is returns to be made from those infrequent but strong market trends that happen from time to time. If we take the example of the post-COVID period, Of course, all of us remember May 2020, where there was headline about crude reaching near zero levels and some of the contracts dipping even below zero. So fast forwarding a few months later, crude was trading around $20, going all the way to $40, all the way to $60, all the way to $80, and then touching the peaks of $95. Now, naturally, one would call this a strong trend when crude normalized to about $20. And it was a very strong trend when a $20 crude went to 40 and onward to 60 and onward to 80. Now, the industry is somewhat divided into two large camps on the topic of how one deals with trend reversals. The first camp goes broadly on the lines of when there is an extreme trend, I want to monetize some of the returns that I may have made and get out of the trend before a potential reversal occurs in the future. But the second camp is a bit more opportunistic in its positioning, and it's staying in the trend as long as it lasts. And we are firmly in the second camp. Now, that might lead to a heightened reversal risk because when markets go to extremes, there is a stronger tendency of a reversal to occur. Now, we adjust for that within our implementation by being more nimble around reversals and being very selective about where we apply the extra reactivity as well.
Fascinating stuff. And when you say we react by becoming more nimble, what exactly are you looking for to become more reactive to those trend reversals?
I think the concept of reactivity in a trend following system, it's usually defined by the look back period, or in the option world, one could look at delta and gamma being the reactivity of the system itself. In our space, we increase our reactivity to sell-offs when we see a high in the market, or
Yes.
likewise, we increase our reactivity to market rallies when we see a low within the market.
Makes sense. And by increasing the reactivity, do you also apply an absolute stop loss to some of these strategies?
So trend following strategies have arguably a natural stop loss embedded. That is, if there is a continuing trend on one direction, let's say long, a trend following strategy is expected to be long that market. And when the strategy incurs a loss in that position, it also means there was a reversal in that trend. So the strategy naturally stops holding that long position by virtue of following the trend in that market at that time. So there is a natural stop loss from that sense. Now, one could also have a stronger reaction to losses than they would have to gains. And this is something that we incorporate within our trend measurement system itself by being a bit more reactive to reversals.
And it's worth noting that this question to stop loss or not to stop loss, we also discussed that at length with Anthony Todd back in January this year. Do you think there's a consensus out there among CTA practitioners as to whether an explicit stop loss makes sense?
Well, the reversal of a trend is also the beginning of a new trend. So for a trend follower, I think it's challenging to have an explicit stop loss because you're also missing out on the opportunity to catch a new trend early enough in that case.
That's a brilliant point. So Jagadish, thank you for providing all that context so far. So clearly you have this platform, you have this infrastructure, you have this data, you have this research. Strategies are working again. It's really reassuring to see all of these trends that are playing out in markets and being capitalized on and captured by CTA strategies post-COVID. So, Jagadish, what's next? Where are you looking to extend your trend analysis and models from here?
So broadly speaking, we are working on 3 to 4 various objectives in the trend following space. The very first one goes into the space of alternative trend following. And this is where we, as a provider within the investment bank, have some natural advantages and some disadvantages as well. So speaking about the advantages first, we are a large market maker for OTC contracts, call it interest rates or FX, some hard to access currencies. And we are a market maker for equities. Now, that is sectors, factors, thematics, long short models that one could trade beyond the usual futures. The second extension of that comes in hard to access commodities. As the joke goes, is orange juice liquid? So I think in this space, what we are looking at is the quote unquote illiquidity premium. So the challenge here is to deliver this harder to access content within our framework of daily liquidity
Yes.
and operational efficiency as well.
Absolutely. Well, I think this area of alternative trend following is a fascinating one. It's clearly an area where many investors are getting in and finding alpha. And it's worth noting that David Dennison at Florin Court spoke at length on this area and the advantages of broadening the traditional CTA universe to less liquid, but arguably less commoditized asset classes. And he argued that the correlation between the alphas in these alternative markets and in the more liquid markets is actually relatively low. That at times of crisis and times of turning points, it's the more liquid markets that move faster than the alternative. So it can be quite a nice diversifier to be gaining exposure to the alternative markets as well.
Absolutely. And continuing on the same point as well, we as a execution house have developed technology into accessing markets on a more intraday basis rather than trading the settlement of futures as we historically did. And today we are able to do that across equities, rates, commodity futures contracts, and also trading OTC contracts such as FX and interest rate swaps at multiple times during the day. And that itself has led to new opportunities in styles that go beyond the medium to long-term trend following space, such as intraday momentum, overnight mean reversion, and some of these trades expressed using instruments that are relatively new and evolving, such as 0-day to expiry options or 1-day to expiry options as well.
And how powerful is that signal out of interest, the intraday momentum signal across different asset classes and also the next day mean reversion?
We've been running intraday momentum strategies from about 2016, and we've accrued a bit of live experience. So we see the returns being somewhat of an episodic pattern, a bit different from medium to long-term trend following, where when there is a sense of illiquidity in the market, we see some of these structural risk premia, as we call it, shine and produce positive returns. And oftentimes, we see them as complementing a medium to long-term trend following model, and we see them working in conjunction to reduce the range of outcomes for an investor and reduce the risk of a long-term trend following model, particularly when markets are moving very, very quickly on a few hours to a few days kind of windows.
That's fascinating that you're leveraging the bank's infrastructure again to support that style of alpha generation. And interesting also that the intraday momentum trends are somewhat of a diversifier versus the longer term momentum trends because they potentially work in different phases of the market cycle. Are there any other areas of extending your trend analysis that are worth highlighting?
So moving beyond the realm of price trend following, we've been spending a lot of time in finding alternative signals to drive the same assets. A good example is the work we have done with this company called Macro Synergy, who have a thoughtful data product that covers various macroeconomic data series in a point-in-time fashion that is quite useful for quant researchers such as ourselves. And in that context, we were looking at the premise of using macroeconomic time series as a way to predict macroeconomic trends, and mapping them using first principles to market variables, such as a strong growth estimate would lead to a positive equity market trend, or a strong inflation estimate might lead to a negative fixed income trend, being a couple of obvious examples.
That's really interesting because the traditional CTA trend following strategies are obviously taking price and volatility movements as the starting point, rather than the domain knowledge, rather than the fundamental backdrop, and rather than the hypothesis of the practitioner. Whereas your point, I think, in terms of the Macro Synergy partnership is let's start with the domain hypothesis, which assets should perform given the macro trends, given the fundamental trends. So you're turning the problem statement on its head in a sense.
Right. And we did have some interesting observations to that point in our own research. One could argue if macro drives price or price drives macro. And we found that the answer is somewhere in between. And in fact, we see both of them happening simultaneously. Taking the example of the 2022 trend, we have seen that trend first occur in commodities, then move to the short end of interest rates, then move to the longest of interest rates towards the end, somewhere in between, affecting the FX asset class as well. Now, the other way to approach this period was to look at the inflation series in itself. And our colleagues at Macro Synergy make that easy for us by having a short-term measure of inflation that is adjusted for seasonality. And using that knowledge, one could, at the same time, predict what might happen with commodities, rates, and FX markets, and arguably be a bit earlier in doing so.
Absolutely. Well, I'm sure the holy grail is what you're alluding to, really, which is looking at all the data at a given point in time, because sometimes the price might move first and the trend might move first, and other times you might actually find the macro data came first. And so if you're looking at all of it, you have a higher chance of getting on that trend earlier.
Right. Apart from this, we're also looking at reversion. And there has been some external research and some of our internal research as well on the topic of using realized skewness of returns as a predictor for what might revert in the coming weeks to months. So that has been another area of research. And thirdly, there's been the topic of time traveler, which Eloise, you have covered in your podcast series in the past as well.
Yes.
Which is a fascinating concept in itself, where we depart from what one could think of as consecutive trend following, or let's say a month of strong returns today being a predictor of the next month, to non-consecutive trend following, where one is predicting what might happen tomorrow based on historical occurrences of the same context.
I hadn't thought about it in the way you're articulating it, that it's like non-consecutive trend following, because of course you are buying the assets that performed well in a similar period historically, which wasn't necessarily yesterday or last month, but was some other point of time in history. So very interesting, Jagadish, to hear you articulate that. I really enjoyed hearing about how you are looking to extend your trend following analysis, whether it's broadening your universe and looking at alternative markets, cross-asset, and also potentially intraday space that presumably diversifies your strategy and improves risk-adjusted returns in the process. And then also, as you say, looking at these alternative signals that actually, in some cases, like macro synergy, start from first principles, start from the macroeconomic trend and infers the price-driven trend rather than the other way round. I think that's a really fascinating space to be looking at, again, as a diversifier potentially to the other trend-following strategies. And you've obviously got some really exciting areas of future work. So I'm really looking forward to staying close to it and seeing how you develop it further. So thank you so much, Jagadish, for taking the time to sit down with us today.
Thank you indeed, Eloise. It's been a pleasure.
Thank you also to our listeners for tuning in to this bi-weekly podcast series from our group. If you'd like to learn more about Jagadish's work and the QIS team, then please do reach out to your JP Morgan sales representative. Otherwise, if you have feedback or if you'd like to get in touch, then please do go to our website at jpmorgan.com/market-data-intelligence, where you can reach out via the Contact Us form. And with that, we'll close. Thank you.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. The views expressed in this podcast may not necessarily reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan. They are not the product of JP Morgan's research department and do not constitute a recommendation, advice, or an offer or a solicitation to buy or sell any security or financial instrument. This podcast is intended for institutional and professional investors only and is not intended for retail investor use. It is provided for information purposes only. Referenced products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures/sales and trading disclaimer. For the avoidance of doubt, opinions expressed by any external speakers are the personal views of those speakers and do not represent the views of JP Morgan.